Welcome to this explainer. I want you to picture something for a second. Imagine a frantic Wall Street trading floor, but it's colliding head-on with a hyper-sterile, ultra-cold quantum physics lab. You've got neon green ticker tapes, symbols like IonQ, flashing right over these electric ice blue schematics of dilution refrigerators. That is exactly the reality we're living in today. For decades, right, quantum computing was just this fascinating but totally distant laboratory curiosity. Well, not anymore. It has officially morphed into a high-stakes, multi-billion-dollar financial asset class. Today, we're going to look strictly at the numbers, the underlying hardware physics, and the geopolitical panic that is literally driving unprecedented capital into companies that haven't even turned a profit yet. Let's get into it.
Okay, let's dive into this massive number, $20 billion. Prepare yourself for a bit of financial shock and awe here, because this is the staggering expected valuation for a company called Quantinuum, right after they filed their S-1 paperwork to go public. Quantinuum, who's actually majority owned by Honeywell, they are the current leader in a very specific type of quantum computing. But to understand why institutional investors are even entertaining a $20 billion valuation for a deeply pre-profit tech company, we really have to look across the aisle at what's happening with their closest competitor. I mean, the money is absolutely flooding in, but the real question we have to ask is this valuation built on solid commercial ground, or is it purely pre-revenue hopium?
To answer that, we turn to rival quantum firm IonQ. They just reported a massive Q1 year-over-year revenue jump of 755%, landing at $64.7 million. And look, this is a vital piece of the puzzle. It proves that real, actual commercial traction and scaling are happening right alongside all the IPO hype. We aren't just talking about abstract theoretical math anymore, we are talking about actual invoiced revenue. With IonQ's first sale of a 256-qubit system, real customers are parting with tens of millions of dollars right now. But before we get too swept up in those massive growth percentages, we really need to balance this with the harsh reality of what it actually takes to scale a deep tech company.
Laying these balance sheets out side by side provides a pretty brutal reality check. Look at Quantinuum. Despite that expected $20 billion valuation we just talked about, their Q1 revenue was just $5.2 million. That's actually down from the previous year, and they posted a net loss of $136.6 million in a single quarter. To justify that massive valuation, they're aggressively trying to ramp up to a full-year guide of $225 to $245 million. Basically, they're asking for an 80 to 90x revenue multiple. On the other side, you've got IonQ. Now, they're guiding higher revenue, around $260 to $270 million for the year, but they're forecasting a massive operational cash burn. We're talking an adjusted EBITDA loss of $310 to $330 million. So the takeaway here, both of these companies are burning extraordinary amounts of cash just to stay in the race.
So, what exactly are they spending all that cash on? Well, to understand that, we have to look at the underlying physics battle. See, when investors buy into these IPOs, they aren't just buying financial metrics. They are placing a massive, high-stakes bet on which physical hardware architecture is going to win the decade. Both Quantinuum and IonQ are betting on what's called trapped ion architecture. This literally uses individual charged atoms suspended by lasers. It gives you incredible accuracy and high fidelity, which is exactly why they're the commercial leaders today. But it is notoriously hard to scale. Meanwhile, the rising threat on the horizon is neutral atom architecture. Think of China's recently announced 200-qubit HANYuan 2 system. Neutral atom offers flexible geometry, lower power, and potentially even room temperature scaling. If neutral atom overtakes trapped ion in the long run, well, the hardware bet placed by today's IPO investors could go very sour very fast.
To defend their lead and actually solve that scaling problem, IonQ just made a monumental move. Shareholders overwhelmingly approved IonQ's $1.8 billion acquisition of SkyWater technology. SkyWater is the largest U.S. pure-play semiconductor foundry. The deal pays out $15 in cash plus $20 in IonQ stock per share. Now you might be wondering, why buy a massive factory? Well, because relying on external fabrication facilities is just too slow. Bringing chip-scale ion trap manufacturing completely in-house is a pivotal shift toward producing those commercial-scale 256-qubit systems faster and cheaper. But there's another, much larger strategic layer to this acquisition that goes far beyond just speeding up production. And that layer is global geopolitics. By acquiring SkyWater, IonQ has secured a strictly domestic U.S. supply chain.
In an era completely dominated by the CHIPS Act and intense international tech rivalries, having domestic manufacturing is essentially a strategic superpower. The U.S. government is pouring capital into advanced technologies, but they mandate that the supply chain absolutely has to remain within national borders. Because of this move, IonQ is now positioned perfectly to bid on massive, highly lucrative defense and intelligence contracts. They aren't just selling to pharmaceutical companies or banks anymore. They are literally weaving themselves into the fabric of national security infrastructure.
And this entire ecosystem play brilliantly illustrates a totally different way to invest in the quantum wave. Instead of trying to guess which quantum computer will win the race, you can look at the infrastructure required to run any of them. Consider FrostByte. This is a startup that recently raised 1.3 million euros in seed funding to develop what are called cryo-CMOS chips. These are specialized control electronics designed to operate at mind-numbing, cryogenic temperatures. They're built specifically to resolve the massive thermal bottlenecks that are currently plaguing the superconducting quantum computers being built by giants like IBM and Google. Let me show you exactly why this specific technology is so vital. We call this the cabling scaling bottleneck, and honestly, it is a brutal physics problem. Step 1. Your superconducting qubits have to be cooled to roughly 10 millikelvin. That is just a fraction above absolute zero. Step 2. The classical computers controlling them, well, they operate at room temperature, around 300 Kelvin. Step 3. To bridge that massive temperature gap, you have to run thousands of long physical wires right into the cooling chamber. 100 qubits might need 1,000 wires. But here's step 4, the real kicker. If you want to scale up to 1,000,000 qubits, which is the holy grail of the entire industry, running millions of physical wires is literally impossible. The heat and noise would just destroy the whole system. FrostByte's cryo-CMOS solves this by putting the control electronics inside the freezer with the qubits. Without completely new infrastructure like this, the industry simply cannot scale. This brings us to a highly familiar investment narrative, the picks and shovels analog. Think back to the recent AI boom. NVIDIA didn't capture the lion's share of the market by building the absolute best AI chatbot. No, they captured it by providing the GPUs that every single AI company needed to survive. The exact same logic applies here. The smartest, and perhaps the safest, quantum investments might not be betting on trapped ion over neutral atom. It might be investing in the supplier ecosystem. You know, the companies providing the cryogenics, the photonics, and the control chips. Because no matter who builds the winning quantum computer, they are all going to need these advanced picks and shovels.
But look, it's not all just distant hardware scaling. There is immediate real-world economic value being generated right now. Take a look at the recent partnership between the King's Foundation and FormationQ. Instead of sitting around waiting for a perfect million-qubit machine, they're using hybrid quantum classical workflows today. Classical computers do the heavy lifting, while quantum optimization algorithms step in to tackle incredibly complex municipal challenges. We're talking about figuring out the absolute most efficient placement for electric vehicle charging stations across an entire city, or optimizing massive municipal trash routing. When a city can save millions of dollars in operational efficiency this year, it clearly demonstrates the tangible near-term ROI that actually justifies corporate investment in quantum tech right now.
However, municipal trash routing is not what keeps Wall Street bankers and Pentagon generals awake at night. This is Q-Day. Q-Day is the speculative future date when quantum computers become powerful enough to just shatter RSA 2048 and elliptic curve cryptography. If that sounds overly technical, let me translate it for you. It is the day the encryption protecting almost the entire internet, every banking transaction, and every secure government communication is broken. It is the ultimate doomsday catalyst. The urgent race to develop post-quantum cryptography is the invisible engine driving a massive portion of the billions of dollars flowing into this sector. The risk is simply too catastrophic to ignore.
So, the absolutely crucial point here is that this isn't a problem for the year 2100. The timeline is collapsing. Today, we only have a few hundred physical qubits. But in just 5 to 15 years, experts project we'll hit that 4,000 to 8,000 logical qubit threshold necessary to break standard encryption. Because of this, major tech infrastructure companies are forcing a migration right now. Cloudflare, for example, they've announced a forced migration to post-quantum TLS web encryption by 2029. Banks, corporations, and governments are being legally and structurally mandated to overhaul their cybersecurity infrastructure today. And there is a very dark, very specific reason why they literally cannot afford to wait even one more day.
That reason is the immediate store now, decrypt later threat. Adversarial state actors are not waiting for Q-Day to start their attacks. They are actively siphoning and hoarding massive lakes of encrypted internet traffic right now. They know they can't read it today, but they are patiently waiting. That means the highly classified corporate trade secrets and government intelligence sent in 2026 will simply be decrypted and fully exposed in 2036. This terrifying geopolitical intelligence threat is exactly what is forcing immediate procurement rule changes in defense agencies worldwide. And frankly, it perfectly explains why these deep-tech quantum hardware companies, despite burning hundreds of millions of dollars in cash, are commanding such enormous, sky-high valuations. The governments of the world literally cannot afford to let them fail.
So we've seen the $20 billion targets, the staggering Q1 losses, the brutal physics bottlenecks, and the looming shadow of Q-Day. Quantum computing has undoubtedly arrived as a major financial asset class, complete with ringing IPO bells and massive acquisitions. But as we look at the reality of the balance sheets against the incredible, world-changing promise of the technology, I want to leave you with this to consider. Will these multi-billion-dollar quantum valuations actually hold up when subjected to the harsh light of the public markets? Or is Wall Street desperately pricing in a technological future that, in reality, is still decades away? Keep an eye on the numbers, because this race, it has absolutely just begun.